So I'm going to run you through the idea of what I call the startup funding formula. Everything's a formula for me, basically. If you look at any of my courses and things like that, they're all with formula. So everything's just a formula. And also, if you guys help me, keep me honest, and remember at the end of this, I'll offer this to Barry, Kiki, I'll do it for you too. I'll give you just free access to this course. I have another course that goes even deeper into this. It's more if you were the entrepreneur trying to raise capital, but the idea from there is you could just sort of learn how they do that and the way I teach it, if this is something you're thinking about. So I'll get you guys access to that. So let's talk about it a little bit. So the idea here is raising capital from investors. Now, the key is with any business, right? You guys know this by now. If you don't have money, there's no fuel to grow. Certainly not every business needs capital in order to grow, right? There's this idea of bootstrapping. So there's this idea of running a lean business, and bootstrapping meaning you just work with the revenue that you're generating to kind of build and grow. And now, but there are other businesses that without capital, they can't really grow. And these are typically true for the best examples are high growth startups, right? Tech companies, things like that. They need an absolute bucket load of money in order to grow. And so trying to bootstrap, while some can do it, there are stories of those doing it. Others need a whole bunch of capital. And so they go to investors to raise that capital because you can't get a loan for most startups. Why? Because as I've taught you, startups, when loans are historical based. Well, if you're a startup, what history do you have? You don't have any, right? So that's why you see all these folks, Shark Tank and things, going to startup investors to try and get them to give them capital. The other reason they do this, and the other reason sometimes capital does matter, and you can't just be lean, is because the market is so competitive. If you don't raise enough capital, you can't scale quickly. You can't grow quickly. So then what happens? People see what you're doing. And if they've got more money than you do already, so, say you're trying to compete with a Netflix, right? And maybe you're doing something slightly different than they're doing, but they've got bucket loads of money right now. The stock's down quite a bit, right? But they have a ton of money. Well, they can just sling that at this idea and outpace you, which is why a lot of these high growth startups have to raise money from outside investors. They just can't do it through bootstrapping. They just can't do it through loans because it's not historical. So that's a really key thing to remember. Now, what you may not know about me is I've been in a lot of people's shoes before that are in this startup world. My first startup was a little business called Go Grab Lunch. We were named a $1 million idea by Business Insider back in 2010, and we grew to members in 45 different countries. Now, that's not counties. That is countries, guys. I had members in 45 countries. As a matter of fact, there were 620 Peruvians using Go Grab Lunch to network with each other, right? So the challenge for us is we struggled to monetize. And without monetizing, what couldn't I do? I was determined to bootstrap. Well, we weren't monetizing well enough, so I couldn't bootstrap. And by the time I got into investor conversations, it was just too late. And we just couldn't scale fast enough to keep up. We were the first in the market. And later, even today, there are models like it, companies called Lunchtree, Lunch Club, they're Bumble, if you know the dating app, they even do something similar to what Go Grab Lunch did in its early days. So raising capital for these businesses is really what it takes to really get going. You can't scale to 45 countries, especially if you're not monetizing and you don't have the capital to do so. So I got really busy learning how startup funding worked. I was originally a commercial lender, as you guys know, of C-suite. So I was a chief lending officer, knew exactly how the business loan world worked, but I wanted to learn how the venture capital angel investor world worked. And I learned everything I could about how that business worked. I eventually was able to sit in and pitch competitions and judge them. I was the manager of a local incubator where a bunch of biotech companies are housed, one that sends experiments up to the International Space Station. I managed that incubator and learned everything I could about it. And I even today, definitely at a smaller dollar amount, but I even do some startup investing of my own today. So you guys know me pretty well, but since I'm recording this, I'll just say the key to remember about me is former C-level bank executive, 3-time startup founder, over $800 million in deals. That's a mix of loans and equity deals, right? So when you're raising capital, you have debt, which is loans, then you have equity, which is investors, which is really, really what we're talking about today. So I'm going to teach you what I've learned about how you can attract investors. And for you guys, I'm going to teach you how you can turn this knowledge into helping other companies like the incubator Barry's at today raise capital as a startup, right? Plus, I'd mentioned to you guys, got a bonus for you at the end, and we'll get that to you. So there's a couple different ways to finance a business, right? And I've talked about 2 of those already. I've talked about this idea of loans. I've talked about this idea of investors. There are grants as well, but I want to be honest with you and tell you that there's no such thing as free money, right? There kind of is, right? So the government will give away free money for various things. They do that through a couple of things called SBIRs and STTRs. These are basically grants that go to science-based entities that are doing studies around the things the government cares about. But at the end of the day, those are very specific use cases. You have to apply for them. The process is extremely rigorous. And so I tell people there's really no such thing as easy grants. Some people confuse SBA loans as grants. And you guys have learned through the course already that that is not what they are. They're definitely not grants. So there's just a lot of different ways to finance them. And the key is to understand which one is right for the business that you're in. So in general, existing businesses with multiple years of tax returns and profit typically would fare better by getting loans for their business. Whereas if you are a true startup, you're going to be generally speaking, a little bit better to do investor finance and things like that. So here's the key to remember. There's two different things that, and I want you to think of lenders as investors too. Why is that? Because a lender is technically investing money in your business. Now, the way they go about that's a little bit different. They want you to give them regular payments to pay them back, right? And in equity investing, they don't get their money back until what's called an exit occurs. So it's a little bit of a difference, but either way, both styles or both types of capital are investing in the business. They're giving money into the business. Now, one of these types is very historical focused. I bet you guys know which one that is, right? And one is very futuristic focused. And I want you to think about these next couple of slides in that light. So when we talk about being historically focused, what we're saying is, what have they done? And I want to append a little bit onto this that I just didn't feel like putting on the slide. What can they prove they have done, right? So if you're working with someone who needs capital to grow and they say, so Barry, I'll just use an example. You're working with a gentleman right now and you told me that, he used to do X number per, I think it was week or something like that of his type of business. And all of a sudden he's doing a lot more, right? So how does he prove that? That should show up on his financial statements. He should be having more revenue come in. And so that's what you want to think about when you think about historical. What have you done? Can you prove you have done? When they're futuristic focused, they're thinking about what will you do? What is it you are going to accomplish? Not what have you done, but what will you do? Now, can you start to guess which one's going to focus where? Lenders are the ones that are historical focused. You guys have been through the course on commercial lending. They want tax returns. What are they looking for? What have you done, right? I'm going to be able to prove what I have done because my tax returns show I'm earning this much money and I'm growing this much year over year over year. So that means investors are the ones that are futuristic focused. They don't really care as much about what you have done. Everything they're focused on is what you say you're going to be able to do. And because they are focused futuristically, they look at things a lot different than a lender does. You don't want, when you're chasing capital, either for yourself or for clients that you guys work with, you don't want to waste a lot of energy chasing the wrong funding source. So we're going to talk about the types of investors, because this will tie into what they look for in things. So there's four main things I want you to think about when it comes to startup funding. You've got individual investors. I mentioned I do some minor, very small dollar angel investing. So individual investors. You have what's called an angel syndicate. So I have a very good friend here locally. He runs the largest angel investor syndicate in the Southern United States. They have membership in 12 different cities and they do those deals across those cities. That's how that works. Then you have venture capitalists. Everybody, I think you definitely know that term, right? VC. And then there's PE, which is private equity. So these are the four main categories of investors for you to think about. And they all focus on things in a different way and in a different timeline. So what I'm going to run you through now is what I call the capital continuum. And it's this idea that there's a timeline of funding that occurs. Remember, we're focused on startups, right? There's a typical timeline that occurs and who is appropriate at what phase of that timeline, okay? So the first place to focus is here on the bottom left. You see this little acronym FF&F. What we mean by that is the founders themselves of the startup, the family members, and their friends. I'll do that again. That's the founders of the startup, the family members, or the friends, okay? Sometimes we joke and say that's the founder, family, and fools, meaning anybody who's dumb enough to put money in their startup. But this is generally early on when they just have an idea that they're thinking about and they like to go around to their friends and family and tell them what they're doing. And mom or dad may be fortunate enough to have some discretionary income that they can invest in the business, or maybe there's some friends who are willing to put some money into the business, something like that, right? So that's the FF&F stage. Then, if you notice, I'm kind of sort of leaping. So something happens between FF&F and angels. And I want to talk about the angel for just a minute. Why are they called angel investors? So there's this kind of these really nice, the idea is they're these really nice individuals who either like to invest in startups because they were an entrepreneur themselves and they want to sort of give back, or they're looking for another way to be able to sort of diversify their investing portfolio. So maybe they already do lots in the stock market and real estate and things like that. That's okay. They just come back and they want to invest in startups, those types of things. So they're looking for an alternate way to do it. So you have FF&F, and then they accomplish what we call some things. And next thing you know, the angels will do the next round of funding. We call it a series of funding. Okay, then after the angel investors is when we typically get to the larger institutions, which are VC. So angel investors are usually individual people who invest on their own money. VCs are managing buckets of money on behalf of other people, and they make the decision themselves on what they're going to invest in. Whereas an angel investor will make their own decision. A VC does it on behalf of everybody, and then they put larger sums of money into the startup. Then some more things accomplished, and then we see private equity and come in, and private equity is typically buying chunks of a business because they feel like they can improve upon it. It's not doing as good as it could, and they're going to improve upon it, and then they're going to have an exit and they're going to make some money. Now, this is a bit of a generalization that it always happens in this perfect flow, but the concept is important to grasp. You can't generally be a brand new startup and you've not accomplished a whole lot. You just have an idea, and a VC firm is going to touch you. They want you with some more accomplishments. You might just have something, what we call a prototype, maybe a customer or two, and that could be appropriate for an angel. So you have, what these arrows represent is the idea of accomplishments, things that you are able to pull off. Maybe you've got your first patent, your first paying customer. Maybe you've got your first $1 million in revenue, those types of things. And as these accomplishments, these milestones, this traction occurs, you're able to move to the next stage of funding. And what I don't have for you is on here, you would see lenders. So going back to what we did with the futuristic and the historical, this is, again, a bit of a generalization, but it tends to hold true. Within investing, venture capital and private equity tend to be a bit more historical focused. Why is it? Because they're later in the process of growing a business. So there are historical things they can point to say they're doing a good job. Whereas on this side, these folks are very futuristic focused. Remember family, friends, and fools, or founders? These are, your mom and dad aren't giving you money because you've shown them that you can get $1 million a month coming in revenue. They're generally giving you money because they just like you and believe in you and think you have a great idea. So you just want to think about these things in that way, where you've got this idea of futuristic and historical, moving along this line of capital from founders, family, friends. Then angel investors will pick you up, which is what you see with Shark Tank. After they get done with you, they kick you off to a larger venture capital firm. Sometimes you go to a private equity firm, and along the way somewhere, there's an exit that occurs and those people get paid back. I'm going to run you through a couple of things that investors are looking for. And this is probably the most important part of what we're doing, because when we talk about the commercial loan side that we've done together, there's these pre-screening questions I keep talking about. So if you get startups that you're talking to, if you have an idea in mind what an investor tends to focus on, you'll know if it's a very interesting thing for folks to focus on. Okay. So I'm going to go and run you through those things, and then we can do some Q&A and stuff like that. So the very first thing I want you to think about is the team. Investors focus on a team. The statistics show that an investor's decision, whether or not to invest in a business, is somewhere between 60 and 80% based on the team alone. Now just think about what I said. That's a big weight focused on the team. Why is that? Because if an investor is very futuristic focused, there's no documents they can really look at to say, oh, they've been making all kinds of money, like a tax return, like a lender does, right? So what are they trusting? They're trusting on execution, the team themselves. There's a little saying to get used to if you work with startups, and that is that they bet on the jockey, not the horse. The jockey being the team, the horse being the idea. They want the people that are running it. They make a bet on the people. So if you see a founder who has tons of experience in their space, maybe they had a I don't know, a space engineering background, and they worked as part of SpaceX and things like that. If that individual were trying and go start a startup in the same space, it would get a lot of extra credit than someone like me who's never done that and says, "Oh, I'm going to go spin up a space company," right? Another thing they focus on is teams that have had exits before. Remember, with an exit, that's when a startup grows and they merge or IPO or something like that. So that's why you see founders who have had exits before get checks from investors a lot easier. So some of these folks that you see that are popular founders, they tend to have an easy job raising money. But why? Because they've had success before and they've made their investors money. So they're writing checks. So number one is they focus on the team. The second thing they focus on is some unique ideas. And why didn't I just say an idea, right? An idea doesn't mean anything. Back to the idea of team, doesn't matter how good the idea is. If the team can't execute, it doesn't mean anything. But a unique idea will intrigue an investor. Now, this is a little bit of a touchy subject with people, but I will tell people a lot of times there are no truly unique ideas. And if I've talked to you guys about this, I apologize. But the example I give people is who was before Facebook? A lot of people can name that one. They can say, well, it was MySpace was before Facebook. But I'll ask you this, who was before MySpace? It was a company called Friendster that next to no one has heard about. And Friendster was huge. Facebook doesn't do anything entirely 100% unique compared to Friendster. So there are no truly unique ideas in the world. There are just variations of unique ideas in the world. You know, SpaceX is not new, right? NASA was going up to the moon and to space long before SpaceX, but it's how SpaceX is accomplishing it. So they like unique ideas because that makes it harder to replicate. If it's a fairly unique idea with a really good team, now we're starting to get some power. Investors also like really large markets. So you don't want to try and go after a market of one. So this is why when you talk to founders, you want to make sure that they've gone out and done what's called validate their idea. A lot of founders will call me and say, hey, I've got this great idea. It solves a pain point that I personally have. And I say, great. Who else have you talked to? Oh, I talked to mom and 5 of my best friends, and they all said it's a pain point for them too. At which point I'll say, okay, cool. But outside of people who really know you, how many people have you talked to see if that's a pain point for them? Sometimes the things that are pain points for us are not pain points for other people. And there may not be pain points that people will pay for, which is critical. So you want to go out into something that you can validate is a need, but also has a large market opportunity. It doesn't make any sense for an investor to put money into what you're doing and need a 10 or 20x return on that money if the best you can ever do is $100,000, because that's as large as the market's ever going to be. So you want something that's a really big market. You'll hear them call this a TAM, total addressable market. The fourth thing that they really focus on is intellectual property. That's what IP stands for. That's intellectual property. So that's things like trademarks, copyrights, but the best of the three is patents, and not patents that are pending. You'll work with some startup founders and they'll tell you, hey, I've got a pending patent. Big whoop, doesn't mean anything. All of us could have a pending patent for an idea we have in about 10 minutes on the internet. What you want is an issued patent, meaning the patent office said, this is unique. This is unique. Why does this matter to investors? If they get an issued patent, it makes it harder for competitors to fight with them, right? If you got that adds back to sort of this unique idea, but you have something that's called defensible. When you have an issued patent, your property, your value is defensible. And so investors really love this. I mentioned one of my friends, he runs a large angel syndicate. This is one of the first things they'll ask is, do you have any issued patents? And I have seen them work with folks and have people pitch them before, and they'll say, yep, and my patent number is 4529674. And that's just a great way to get started with an investor. So intellectual property. I mentioned copyrights and trademarks. They're less impressive because it's not that hard to get those things. So copyrights are usually on music or software, things like that. And trademarks, you've seen the TM on a logo or something like that. That's neat and all, but I can just create another logo that looks a little bit like it, call it something totally different, right? The real thing you want when you talk about intellectual property is issued patents. And then the fifth one is traction. So when I did the piece, go back and look at it, where I'm talking about moving from the FF&F stage to angels, to venture capital, to PE, and I drew these arrows. I mentioned this. I talked about this idea of milestones or accomplishments. I called it also traction. So that's what this is referring to. And traction shows exactly what that image shows on the left. You're getting some momentum. You're accomplishing some things. Investors like traction because it is one way of validating that what the startup is doing is catching people's attention. It has a lot of potential. So again, traction can be things like first customers, first 100 customers, first $1 million in revenue, an issued patent, all of these kinds of things, a prototype that you can share with people. These are all pieces of attraction. A lot of these tie into this one, barriers to entry, but there can be other barriers to entry. So if you study business, there's something called PEST, which is political, environmental, social, and technological. And these are all risks that occur with business. Those same things can create barriers to entry. So the best example I can give you is there can be barriers to entry for things like socially responsible businesses, right? So if you have a business that is in a space that maybe the government is encouraging other people to do, or they make it harder to apply to be part of, maybe you have a business that is in the wellness space, these types of things. A barrier to entry makes, remember this word defensible, makes your idea defensible to investors. One really excellent barrier to entry is having the most market share of everybody, right? So a great example of an existing company that has a barrier to entry is Apple with their iPhone. You know, it wouldn't be very wise for a company right now to try and spin up a new phone to compete with the iPhone because Apple just has almost all the market share that there is. That's a huge barrier to entry. So investors really like that. And then they also like some skin in the game. So one of the things, what I'm trying to say here is you want a founder who has some of their own skin in the game. What I tell entrepreneurs is it doesn't have to be a lot. Even if you just, you know, not everyone has a lot of discretionary income to invest in their own business, but you should invest what you can afford to lose. So I want to be clear about that. You should invest what you can afford to lose. Why is that important to an investor? Well, if you won't risk your own money, why should an investor? So I want to kind of let that hit home. I think that's a really important part that a lot of people miss. I've worked with entrepreneurs and they'll say, well, I don't really have any money. I'm like, you know, scrape together $100 and have your own logo made, you know, at least be able to say you've taken a little bit of the risk. Investors don't expect you to take the same level of monetary risk as they are. That's why they're an investor, right? They know that you need their money. That's just part of the game that exists. But having some skin in the game shows that you really believe in what you're doing. It's hard to ask for money from someone if you're not willing to risk what you can afford to lose as well. I'm not encouraging you to go out, mortgage yourself into all kinds of debt that you can't afford. Just put what you can afford to do at risk. My first startup, I literally funded it with the money my wife and I had out of our pocket. It was basically what I thought we could afford to lose in the venture.